they are very, very referred. Referred here means that they are highly respected. Okay. We might not really appreciate external auditors or external auditing in Nigeria as much, but in advanced countries, Europe, America, they attach so much importance to the external auditors report. In fact, I will use this analogy that after God, the next person that they believe or they respect so much are the external auditors. So they believe that they cannot be faulted. And that is the reason why over the years, it's come to their realization that external auditors, they are not angels, right? They, they are humans. Blood flows through their vein. And as a result of that, they are also susceptible to making mistakes. They are susceptible to perpetrating fraud. Okay. They are just like normal humans. The only thing that separates external auditors from other humans is the fact that they have been trained to be upright. They have been trained to uphold integrity. Okay. But we always say, uh, we always have some bad apples, okay, in a bunch. And that is what has led us to this topic, okay? So to say, in Nigeria, we have not had any celebrated case or cases relating to external auditors being prosecuted or external auditing firm being prosecuted for their wrongdoing. We've never had such in Nigeria. But in advanced countries, we have seen several, right? I think this year or last year, we had the Silicon Valley Bank that had issues, right? So that's just by the way. So that is the backstory that led us to where we are, what we are discussing today. So that is the introduction or overview of what we will be discussing today. All right. So what do we mean by auditor's liability? Now, as auditors, you are expected to be to exhibit what we call due care, skill, and competence. As auditors, you are expected to demonstrate what due care, skill, and competence in all their professional and business relationship. Okay, you're expected to demonstrate. I'm coming. I'll come up shortly. Okay, you can hear me now. The network is breaking. Okay, I was saying something about what we mean by auditor's liability. The auditor's liability will mean that the auditor has a duty to ensure that they demonstrate diligence, due care, and competence in all their business and professional relationships. Okay? But there are instances where this cannot be what? Cannot be found or cannot be established. Where this is not established, that is where the auditor is not found to be competent, diligent, and demonstrate due care, then auditor's liability will come in. That is, the auditor will, as a result of his negligence or her negligence, is going to suffer from what we call auditor's liability. Okay? So that is what we mean by auditor's liability. Um, I've talked about this, so that's why I'm seeing I'm scrolling down. I've talked about this. Okay? So one thing you also need to know about this auditor's liability is that we can look at it from three dimensions. Okay? We can look at auditor's liability from three dimensions. Number one, we look at it from the law of contract dimension. Second one, we look at it from the law of contract dimension. Second one, we look at it from the angle of law of tort dimension. Then thirdly, we look at it from the angle of what? Criminal liability dimension. So there are three aspects: law of contract dimension, criminal liability dimension, and law of tort dimension. Those are the three dimensions to exploring or to explaining auditor's liability. Okay, I hope you understand. Now, if you go back to, let's look at it, the dimensions one after the other. Let's start with the first one, the law of contrast dimension. Now, if you agree with me, when we started business law at our various institutional levels, whether at OND, whether at HND, whether at university, undergraduate, or whether you are doing it from when you started ICANN, you have come across law of contract, right? And law of contract, what it says is this: before a contract can be, before a contract can be said to have been executed or consummated, one thing that must happen is what we call consensus addendum. That is, there must be meeting of two minds. Consensus addendum, meeting of minds or meeting of two minds. That is, two people cannot work together unless they agree. That's what it means. Okay? Now, once that has been established in any contractual agreement, you now look at the what? Element of what? Valid contract. In element of a valid contract, you have some prominent elements. The first one is offer. The second one is acceptance. The third one is consideration. The fourth one is capacity to enter into legal agreement. The fifth one is what? Privity to the contract. All right? I'm not going to bore us with all this because it's already passed. But I'm just going to lay emphasis on the fifth one, privity to the contract. What does that mean? What that element says is that if you are not a party to a contract, you cannot enforce it. That's what it says. Unless you're a party to a contract, you cannot enforce. That is why you see that where there is a divorce is in a marriage, is either a man or the woman that can institute the divorce proceedings. Not their parents, not their friends, not their cousins, not their relative. It's usually the husband or the wife. Do you understand? So the same thing is applicable to business relationship. Okay. Now, if you look on your screen, on your laptop or your phone, whatever device you are using, you will see that where there is a breach of contract on the part of the auditor, that is, the auditor supposed to demonstrate due care, skill, and competence. But in this instance, he did not do so. The directors can institute an action against the auditor. Okay? The director can do what? Institute an action against the what? Against the auditor. I hope you can see my screen. If directors, you can see it right. So you can sue an action against the auditor. Only the directors can sue an action and institute an action against the auditor. Why? Because they are the one that signed the letter of engagement. That is the reason. No other person can sue the auditor under poor performance or negligent performance. You cannot sue the auditor under this law of contract. You cannot sue the auditor under law of contract. Only the directors can sue the auditor under the law of contract. No other person. So should anybody or any party, whether a shareholder or an intended user, remember intended user in chapter 1, banks, creditors, suppliers, all those people, should anybody wish to institute an action against the auditor, they can only do so after the expiration of what? 30 days. After the what? Expiration of what? 30 days. So that means until when the directors have not shown any intention, and that not showing intention must have been after the expiration of 30 days. After that time, you can now sue the auditor on either negligence or criminal liability. Hope you understand. The first one, I just explained the first one now, law of contract. And I said it's only the directors that can institute an action against the auditor. Any other party, any other intended party, intended users that wishes to institute an action against the auditor can only do so after the expiration of what? 30 days. You can see it, I've highlighted it. Hope that is clear. So that is for the first one. Let's look at the second dimension. Second dimension is looking at what we call the criminal liability. Okay? Criminal liability. Now, under criminal liability, the auditor can be sued. That is after the shareholder, after the directors have not, they did not institute an action against the auditor for not performing as expected in the law of contract, in the contractual agreements, okay? Then anybody that wants to sue the auditor under criminal liability must be able to, it means that the auditor has contributed one way or the other, in a criminally minded activity or a criminal activity. That is when you can sue the auditor, okay? And that is contained in the criminal code in Nigeria. So what are those things that constitutes criminal liability against the auditor? Number one, where the auditor accepts appointment as auditor under a statutory provision without being qualified to act. You talk about qualification of auditor in chapter 2 in your regulatory environment. Okay? So for you to say you want to be appointed as auditor, you must not be a body corporate, right? You must be of sound mind. Okay? You must demonstrate technical competence and due care. You must not be an undischarged bankrupt. Okay? You must be an undischarged bankrupt to the amount totaling 500,000 naira and above. Okay? And all of this. So if somebody, accepts appointment as auditors, whereas is not qualified, that is it doesn't have technical competence, is not a child accountant, it doesn't have technical competence, person decides to carry out to accept the appointment, that person would have acted criminally. That's what I'm trying to say, okay? Secondly, where the auditor is involved in fraud, such as what? Falsifying accounting documents or record. Where the auditor is involved in what? In fraud, such as what? Falsifying accounting records and documents. That is self-explanatory. The third one, where the auditor is guilty of insider trading. Okay, what does that mean? That is, when we talk about insider trading, it's a criminal offense. And what does it mean? It means when an auditor utilizes a privileged information at his disposal for his or her own benefit. A case in sight or the cited case is the case of Otto Anderson and Aaron Corporation, where Otto Anderson got wind that the share price of Aaron Corporation will fall within the next couple of days. And what did they do? They heard the information because they are privy to that information. They utilized that information to their advantage. What did they do? They sold off their shares because they had shares in Aaron Corporation. So they sold off their shares to unsuspecting investors. And when those people bought it, they thought they had a great deal, only for a couple of days to come, and so that all the shares they bought were what? Were worthless. So either you call it criminal, either you call it insider dealing, or you call it insider trading. It's the same thing. Okay? That's the same meaning. I hope that is clear. Okay. Another examples of criminal offenses are where the auditor contributes to the winding up of a company, like the case of Aaron Corporation as well. The auditor, Otto Anderson, took up executive capacity in Aaron Corporation. They had shares in Aaron Corporation. So, and they also contributed in doing what? In misleading the investor, thereby leading to the what? The dissolution of the corporation, the Aaron Corporation at that time. That was why they were charged for criminal offenses. Okay? Another example of criminal offenses where the auditor advises the client against what? Tax evasion. So where the auditor advises the client that don't pay tax, just evade the tax. You know that there are two types of two scenarios. We have the tax evasion, we have the tax avoidance. Tax avoidance is allowed, it's allowable. That's when you explore the loopholes in the tax system to your advantage. Okay, that one is allowed. But tax evasion is where the taxpayer decide not to pay tax. Okay, he doesn't want to pay tax. You can see that in advanced countries there have been celebrities that have served different jail terms for evading taxes. Common among them, we have the DMX of blessed memory. We have Wesley Snipes. Okay, even we have some of the greatest footballers, see Ronaldo, Messi, that have been charged. Even Shakira, that have been charged for evading taxes at one point or the other in their career. Okay, then another offense that can be termed as criminal offense is money laundering. Okay, money laundering, we talk about that in chapter 2 when we talk about money laundering. We say money laundering is when an organization or an individual disguises the source of their ill-gotten wealth as though the money was gotten from a legitimate means. That's money laundering. Okay, so if the auditor advises a client that's into money laundering, if the auditor works with a client that's into money laundering, the auditor will be seen as what? As an accomplice or as aiding and abetting money laundering. So it's going to be charged accordingly. Then lastly, where the auditor gives wrong financial advice or wrong corporate advice. We look at that in chapter 3 under the rule of professional conduct, where we say that the auditor needs to be mindful when he's giving corporate financial advice to their clients, because as at that time that he's giving that corporate financial advice, his objectivity is divided. Okay, he has a divided objectivity. It's subjective in the sense that because of the money, because of the fees that the client will pay at the end of the service, it can be obliged to say things that are in favor of the client, even though might not be the right advice. But just to suit the ego of the client, he will advise them accordingly. But what we are saying is this: it's not illegal for you to advise your clients, but anytime you're advising your client, you should always put it there and say that always seek second opinion. Always seek second opinion from other experts so that you can compare what? You can compare notes. Okay, you can compare notes, you can compare the decisions or the options available to you. So you will not be limited to just only one option or one choice. That is why when the auditor gives wrong corporate financial advice, it can be seen as a criminal offense. You understand? I hope we are together. Any question? Any comment?
No.
Any observation?
No, sir.
Okay,
You
for
can
now.
continue. Okay, good.
Yes,
The
please.
last one is the one I call the law of tort, which we call civil liability. Okay, we call it what? Civil liability. Now, you remember that anytime there is a quarrel between husband and wife, okay, and you report it to the police that some couple or a couple is fighting, they are abusing themselves, the police will not intervene. Why? Because they tell you that it's a domestic affair. But the moment that you say that one is being abused physically, okay, the police will now step in. Okay, you understand what I'm saying now? So civil liberty is tantamount to what we call law of tort. Okay, so what that means is that in law of tort is very broad and diverse. But the one that relates to auditor's liability is one that concerns us, and that's what we want to talk about, and that is what we call professional negligence. The one we want to talk about is what we call what? Professional negligence. It's an aspect of law of tort. Law of tort is very broad, okay? But the one that concerns us is one that I just talked about now, which is what? Professional negligence. So a major threat faced by the auditing profession is the possibility of legal claims against auditor as a result of what? Negligence or careless auditing under the law of contract and the law of tort. I hope you can see that. Okay. Now, what is a tort? A tort can be defined as a civil wrong other than that arising under contract, giving rise to a claim for damages. You understand? So like I said, professional negligence is an aspect of what? Law of tort. So the professional negligence, you know that in law, we always make reference to cases. Okay, we always cite cases. So the case that brought about this professional negligence was decided as far back as 1932. And it's a case that we all know about, or some of us have heard about it. Dunlop versus Stevenson. Dunlop versus what? Stevenson. What is the fact of that case? The fact of the case is this. A lady went to a retail shop, just like the regular kiosk that we have now. Okay, went to a shop, retail shop, bought bottled soda drink like Coca-Cola. As at that time, we don't have PET bottles. We had bottles. Okay, so he bought the drink, and he did what? She opened it, and because I don't know whether because she was thirsty or maybe because of the sun or whatever, but she hurriedly drank the contents of that bottle. But upon taking the last drop of that bottle, he discovered that there are dead snail particles at the bottom of the bottle. Dead snail particles at the bottom of the what? Of the bottle. So on citing that, what did he do? She nauseated, she vomited. and she became very sick, okay, and she was hospitalized. So upon her recovery, guess what she did? She did not sue the retail shop. Rather, she sued the what? Manufacturer of that drink. And fortunately for her, she won the case. And this was the judgment of the judge, of the justice, Lord Justice, as at that time. This was the reasons she won. Number one, that the manufacturer owed her a duty of care. Duty of care is that in the production of their drink, they should have been more meticulous, or by complying with what we call good manufacturing practices. Okay? Two, that the duty of care has been what? Has been breached. That is, they negated quality control in the production. Because once quality control is out of manufacturing, then it gives rise to anything negative. Okay? Thirdly, as a result of the breach of duty of care, she suffered losses. What is the losses that she suffered? She had to go to the hospital and she expended her money on drugs, injection, and medication. So those are the three facts that was established, and that was why she won the case against the what? The manufacturer. And that has been the dividing case. Anytime you want to talk about professional negligence in any profession in the world, they must make reference to that landmark judgment. Okay? So imagine you go to a shop now. You are in this caution shop. You went to a shop, Malam shop, a Malam store. You bought your pet coke. Pet coke is brown. But unknown to you, you didn't know that in the course of manufacturing the Coca-Cola, they did not observe good manufacturing practices. So cockroach or cockroaches filtered or entered into the bottle during the completion of the completion of the product. Cockroach is brown, Coca-Cola is also brown, so you will not know. Only for you to, because you are thirsty, quickly, and it's cold, it's chilled, you just took the bottle and you drank it. Only for you to now look at the bottom when you're about to return the pet bottle. You now saw, what is this? Cockroach. Or did it even enter into your mouth? It can be very irritating. So that is what we mean by that, okay? So that was how that is how professional negligence was established, and it has become the landmark judgment anytime you talk about professional negligence in any profession whatsoever. Okay? So how does this apply to auditor? The auditor also owes any party that wants to sue the auditor under law of tort must be able to establish three elements or three factors. That the auditor owes him or her a duty of care. What does that mean? By owing the person a duty of care, that at all times the auditor ought to have demonstrated due care, skill, and competence. Due care, skill, and what? Diligence, or due care, skill, and competence in the performance of his audit engagement. That is, if he has been meticulous and professional in the way he handles the audit engagement, he would not have been, he would not have suffered from what? Professional negligence. Okay? Number two, that the duty of care has been breached or has been broken. That is, you trusted the auditor that he can never compromise, only for you to see that after you have invested based on the auditor's report, all the investment in that organization has become what? Lost or bad. Okay? Three, that because of the breach of care, duty of care, the person also suffered what? Loss. Loss in the sense that the person lost money, he lost, he was not in good, he was hospitalized. So, you know, sometimes like for instance now, for those shareholders of Heritage Bank, when the news broke out that Heritage Bank operating license has been suspended, some of them will find themselves in the hospitals. and they are going to spend money, okay, to recuperate. So that's what we mean. So those are the three things you need to prove. You say that the auditor is what? Is negligent, okay? This is the case I was talking about, the landmark decision. You can see it, okay? You can see it there. I hope we are good, right? So, for anybody, to be able to prove that the auditor has been negligent, again, let's say the third party, for them to prove, they need to prove that the auditor has been negligent. That's number one. They have suffered from financial loss. Number three, there is a causal relationship between the financial loss suffered and the auditor's negligence. Let me give an instance in this case. So you're a shareholder in a bank, and as a result of the like what happened in Heritage Bank, all the shareholders lost their investment. Okay, so there is a relationship between the loss and auditor's negligence in this instance now. Do you understand? So if that is the case, the next one, there are no other traceable costs apart from the proven negligence of the auditor. That is, there's no other thing you can attribute to the loss to the investor. Okay. Then lastly, the auditors had knowledge or ought to have had knowledge that the document prepared and issued by him was not to be relied upon in the particular context. That is, you cannot say you are the auditor and say that the audit report is mainly to the management. The shareholders are also part of that will utilize the auditor's report. So the auditor cannot excuse himself that the audit report is for the management and not to the shareholders. So, and because the shareholders have suffered loss or losses, they will charge the auditor for what? For negligence, if they can prove it. Okay? That's if they can prove it. So that. There have been other cases that also tries to further buttress on professional negligence, okay? Which are what we have here. But I won't bother us with all of this, but you can read it. I've just summarized everything to us now, okay? I've just summarized it. Okay, now, at any time the uh, the third party suffered any loss, they always look for who to push the blame to. Most times they push the blame to the what? To the auditor. That is because of did not do, because he was negligent in the performance of his audit. That was why they are all in this peculiar mess. Okay? So as an auditor, you also stand a chance to prove your what? To prove otherwise. How can you prove otherwise? Number one, if the auditor can prove that there is no due care or there is absence of due care where there are no fiduciary relationship, that is, if the auditor can prove that it does not owe anybody a duty or care, or it does not owe anybody a fiduciary relationship, we can prove that. That is one. Number two, the auditor can also prove that the cost performance of his audit engagement is unable to is able to comply and adhere to the um, generally accepted auditing standards, okay, in the course of performance of his engagement. That is, he complied with all the ISA, ISRS, ISAE, all of those ones. Okay. Then next, if the auditor can show that the alleged negligence had nothing to do with the ascertainable loss suffered, the auditor can prove that it is not because of my negligence that led to your loss of money or loss of investment. If you can prove that, that's another one. Then, if the other defense against the auditor is if the auditor can prove that it's a case of what? Contributory negligence. Contributory what? Negligence. There's what we call contributory negligence. That is, both parties had a role to play in what? In that negligence. Okay? Is that clear? If it's not clear, let me use an analogy to explain. Before now, you used to hear of this all these stand-up comedian, particularly Sheilo, in one of those nights when they had 1,000, night of 1,000 laughs. He was saying that one of the joke he cracked that time was that I'm using that joke to explain contributory negligence now. He said on that particular day, he was going somewhere. He saw an overhead bridge, but he did not want to utilize the overhead because he was running out of time. So he dashed across the road. Knowingly, he also saw the Lagos State kick against discipline, which they are now called Lagos State Environmental and Sanitation Corps. That's their new name now, like yes, okay? That one also ran across the road. So when Sheyilo got to the other side of the road, he saw the high, that is kick against his discipline. He apprehended him and said that he has violated the law. Because at that time, they said that when there is an overhead bridge, when there is a pedestrian bridge, you are not expected to cross the road. You need to use the overhead bridge. And Sheyilo also asked, what did you do also? You also crossed the road. You did not utilize the overhead bridge or the pedestrian bridge. So both of us are what? Are have done what committed what we call contributory negligence. Both of us are wrong. Do you understand? I hope that explains the meaning of that. Any questions so far on this one? Mr. Robert, you are trying to ask a question before.
No, no. I was just acknowledging, you were asking a question without we were here. I was just acknowledging that we were listening. Thank you.
Okay. All right. So that is about the auditor's liability. If there are no questions, we go to the next one. We look at what we call expectation gap. Expectation gap. The best way to define it is what we always call it auditor's expectation gap. And I'm going to use analogy to explain this one also, because as much as possible, I like my students to be able to always pick up their materials and be able to understand the material without any challenge whatsoever. It should be easy for them to comprehend. So I'm going to use an analogy to explain this. Now, imagine you're a man or a lady, and some point or the other, even though I know that there are some people that will not get married, okay? There are some people that will not get, they will never be married. It's not a cause, no way that will get married. There are some people that belong to the LGBTQ community. They don't want to get married. And there are some, I'm talking about the people, my analogy is to people that will get married or those that are already married. For those that are already married or those that are about to marry, there will be a time, or there was a time when you were still searching for Mr. Right or Miss Right, especially for the ladies. So the ladies, once they know that they will get married, they always have a checklist. Now that checklist is not like your normal checklist that you have on paper that you go about with and checking. No, it's not that. This one is a mental checklist. Okay, so it goes in this form. So I want to marry somebody that is boxed up, that has money. I want to marry somebody that is tall, handsome, God-fearing, romantic, and all those things. And they go about with that. So anytime a guy approaches them, quickly the checklist quickly what pops up in their mind. The guy will not see it. It's only the lady that can see it. So as the guy is talking, you see that sometimes, most times, the lady will just be looking at you. The lady, as she's listening to what the guy is saying, she's really doing what? Analyzing her checklist. Is this guy handsome? Is his pocket handsome? That is he rich? Is he tall? Is he God-fearing? All of this. So one, they have confirmed that. Most times, lady will not tell you yes. Okay. So after a while, after persistence, if she sees that you matches her checklist like 80% or 60, 70%, she gives the consent that yes, we can start. Now, you know that so in most instances, you cannot determine human behavior at first glance. You need to get close to the person to know whether the person is someone that you can spend the rest of your life with. So that is when courtship or dating will start. So you now sees that that guy that says he's handsome, is rich, is this. You now get too close. You now discover that the guy is very proud and pompous. You discover that this guy is a woman beater, that this guy does not respect ladies. You saw all of those things. So all those things, all those your initial impression of that guy, what will happen? It will fizzle out gradually. So you see that after a while, that interest, that love will no longer exist between the two parties. Then what happens at that point is what we call expectation gap. Okay? The expectation of the lady has been cut short. We have what we called what? Expectation gap. Okay? So that is the best way I can explain expectation gap. So let's look at it in line with the advanced audit and assurance that we are discussing. Now, there is a way the public perceives the role of the external auditors. Okay? Now, the role of the external auditors as perceived by the public is different from the statutory role of the auditors. Okay? Statutory role of the auditor. So, the statutory role of the auditor, which you all know. Okay? But what we are saying now is that you now have instances where the public will believe that as auditors, these are what should be done at times or at all times by the external auditors. So when there is a disconnect between what the auditor should be doing and what the public feels the auditor should do is what leads to what we call expectation gap. I hope that is clear. So, and these are the misconceptions, these are the perception of the public as the role of the external auditors. Number one, the external auditors report is a certificate of what? Correctness. And anytime you see the auditor's report, regardless of whatever the content, is always a certificate that shows that everything is right with the organization. Okay? Number two, that as auditors, external auditors, your main work is to do what? Is to prevent and detect fraud. The main work of the auditor is to always what? Prevent and detect fraud. Number three, the main work of the auditor at all times is that they always check, they carry out 100% checks of all transactions. They carry out 100% checks of all transactions. That is the way the public sees the auditor. Those are the three ways they see the external auditors. One, the audit report is always correct. Number two, is responsible for the prevention and detection of fraud. Number three is it carries out 100% checks of all transactions. Those are the three perceptions of the public of the role of the auditor. Okay, I hope that is clear. Now, you agree with me that this is not completely true, or this is not even true as the role of the auditors. So, what are the things the auditor ought to do? So, with that leads us to how these gaps has been addressed. Number one of the ways that these gaps have been addressed is that as auditors, right? As auditors, right? the duty of prevention and detection of fraud rests with the management and not the auditor. That is one. Number two, the auditor at all times do not carry out 100% checks of all transactions. That's why we have audit sampling. They don't focus on, they carry out, they use sample to check on those areas that are what? Important. Thirdly, the auditor's report, the auditor's report at all times, right, does not convey that everything is right with the organization. Okay? So there are times where there are disclaimer clauses on the report. There are times where there are what? Disclaimer clauses on the what? On the report. Okay? Where the auditor will say that the auditor will say that he's not okay. So disclaimer clauses will arise where the auditor will give certain conditions to the report saying that I'm not sure this report is fine by me. You understand? It's going to put some disclaimer clauses that I'm not sure. Whoever decides to utilize the audit report does so at his own risk. Disclaimer clause is different from disclaimer report. Disclaimer clause is when the auditor says that whoever relies on the auditor's report does so at his own risk. But in disclaimer auditor's report, what that means is that the auditor will say that he's not a party to that report. Okay? You see that there are two different things. So that's how you know. You understand? I hope that is cleared. So we've been able to talk about resolutions of the auditor's extension gap. Now let's go to the next one. The main element of the auditor's extension gap. Element of the auditor's expectation gap. There are three main elements. The first one is the standard gap. The second one is the performance gap. The third one is the liability gap. Let's look at them one after the other. The standard gap. Standard gap says that this occurs because of a perception that auditing standards are more prescriptive than they actually are, and that auditors have wide-ranging rules that they must follow. Let me explain it. This is too technical, right? So we're talking about standard gap. We know that for you to be an external auditor, you must be very vast. You must be knowledgeable about the IFRS, National Financial Reporting Standard, one, ISA, National Standard on Auditing, and other auditing guidelines, okay? So what that means is that, and every time there are updates, okay, on this standard, and the auditor is supposed to keep abreast with the information, okay? The auditor is supposed to keep abreast with what? With the information. So where the auditor is not updated with the latest information, it creates what we know as what? Standard gap. Do you understand? It's like a doctor now. In the 90s or early 2000s, as a woman that wants to give birth, 2 CS, can only give birth to 4 children at a go. I mean, anytime. Okay? In the lifetime of a lady, if the lady is giving birth 2 CS, they can only give birth to 4 children maximum in her lifetime. But medicine has evolved over the years. And what I mean by that time, 4 years, four times, is that they are going to cut the 4 areas. They cut a different size of the tummy to bring out the baby. Okay? But that has changed now. So because of the advancements in modern medicine, a lady can give birth to as many children as possible, even through CS. So what they just need to do is that they will only bring out the baby from only one side of the tummy. Okay, and that is the only place that will be operated on at every time, every point in time the baby is to be delivered. So what has brought to that? Because of the advancements in modern medicine. So if you're a doctor and you have not been updating your knowledge in medicine, that means that any person, any patient that comes to any pregnant lady that visits your hospital for child delivery, you give that limitation that the person will be able to only give birth to 4 children. But if you have updated your knowledge and training on medicine, then you will know that there is no limitation to how many children a woman can give birth to. That's what I'm trying to say. Okay, that's that. So if there is a disconnect in the knowledge obtained by the auditor in the conduct of his audit engagement, it leads to what we call standard gap. Second one, performance gap. This occurs because of a perception that audit work has fallen below the required standard. Performance gap here means that there is a level at which auditors are being looked upon. Before now, once you say you're an auditor, they give you so much respect. But these days, now you see that most times auditors are being prosecuted, especially in advanced countries, for what? Professional liability or professional negligence. So the performance level of their work as what? Has reduced. The quality of the audit work as what? Has reduced. Number 3, liability gap. What does this mean? This arises from a lack of understanding about the auditor's liability and who the auditor may be liable to. Okay, what does this mean? So before now, before the era of www, internet, right? When they want to hold the annual general meeting, what do? They normally print out the annual account and report, and they give a copy to each and every shareholder during the AGM, right? But these days, we have adopted IFRS. And with the adoption of IFRS, the audit report now is now very voluminous, very bulky. So most companies, they are trying to reduce costs. The cost of a ream of paper is so high that it will not be economical for them to print all of them. Let's say you have like 1,000 shareholders, they are going to print, let's say, 500, 1,000 copies of 1,000 to print 1,000 copies each. You have 500 pages of each of those annual account and report. They're going to give it out to 1,000 shareholders. So what that means is that it's a waste of money. So most companies, what do they do now? They burn the report. They put it in what? In CD writer, CD recordable, writable. That's what they use now. Okay? They use the CDR or CDRW. Okay? So they give it to their shareholders. So when they get home, if they have system, laptops, or desktop, they can do what? They can watch it. Okay? And you know that once the annual general meeting is gone, that paper becomes redundant for most of them. That's why I say that after a while, they give it or they sell it to the poly seller or the yam seller or the suya seller. They sell it to them to use them to wrap their what? Their products. So, but in the advent of the World Wide Web that we are in now, internet, there's no limit to who can prosecute the auditor. What does that mean? So when the auditor's report is out now, what they normally do as against printing it out, they publish it on their what? On the company's website. And anybody that has access to the company's website can access that information. So somebody can be in a far place, let's say in China now, and is suing the auditor that audited report in Nigeria, saying that he has been negligent in the performance of his audit work, that he did not do the needful. And if he's able to prove that, the auditor will become what? Liable. You understand? If he's able to prove that, the auditor will be what? Liable. Do you understand? Like in the case of Wirecard in Germany and Ernst& Young Germany, okay? They've been the one auditing the Wirecard company. Wirecard is more like a fintech in those days, right? It's around 2017 or thereabout. So they've been their auditor. And somebody from that was not a shareholder saw that there was an accounting balance, there was an account balance that represents either a loan or something, a loan that ought not to be in the account. The person look at the account, the comparative figures for the last year and the current year, so that that money, that balance ought not to have been there. The person was not a shareholder, was not even in the country, but he wrote, he petitioned that the audit report of Ernst& Young Germany and for Wirecard is incorrect. And that was how he was charged. The audit firm was charged for what? Professional negligence. So that means that there is no limit to whoever can sue the auditor, whether they have access to the what? The information. So don't think that because you are an auditor that audited the company in Nigeria, if somebody is interested in that company and the person is not in Nigeria, anywhere, they can sue the auditor for professional negligence. Okay? That's what we mean by liability gap. I hope that is clear. I'll talk about this. I'll talk about this one too. Responses. That's when I talk about the corporate governance, that management is responsible for the prevention and detection of fraud. Okay, that's when I talk about that. Okay, then I talk about electronic reporting. The next one I want to look at now is fraud and error. Fraud and error is discussed under ISA 240. Fraud and error is discussed under what? ISA 240. Okay, what is fraud? What is error? The difference between the two is the intention behind the act. The intention behind the act is what makes the difference between a fraud and an error. Error is unintentional act. Why fraud is an intentional act with the motive of what? Circumventing controls for that person's benefits. Okay, that is fraud. And there are two types of there are in error. There are two main types of errors. We have clerical errors and we have errors of principle. What are clerical errors? These are errors that will not affect the trial balance. The errors of omission, errors of commission, and compensating error. They are called clerical errors. That is, these errors, even though they are committed, it will still not affect the trial balance. You know, trial balance is an account that tells the identical accuracy of postings, both on the credit and on the debit side. Okay? So you want to prepare a financial statement now. The first thing you need to look at is what? Is the trial balance. You use the trial balance to prepare the financial statement. So if the trial balance, if it's accurate, then automatically your financial statement ought to what? To be accurate. It needs to be balanced. Okay? So these errors, you talk errors of commission. Error of commission is where, for one reason or the other, the accountant did not put in the right amount. For instance, they bought something of 50,000, but the person recorded 5,000 on both sides. If the person recorded 5,000 on both sides against 50,000, it's going to balance. Both debit and credit will be what? 5,000. It will balance. Number two, errors of omission. This is where the transaction posting is completely omitted. They did not even post it at all. So yes, it doesn't have any effect. So it's going to balance. That's errors of omission. The third one is called compensating error. Compensating error is error that the effect on the debit side net off or offset the credit side. So both of them will what? We set off against themselves. We call it compensating error. That is, the error on one side has been cancelled at the other side. Something we call like the contra entry in your bank transaction statement. Okay, we call it contra entry. So they cancel out each other or one another. Okay, those are the clerical errors. Errors of principle is when the principle, the fundamental, the golden principle of accounting is become what? Has been negated. What's the golden principle of accounting? For every debit entry, there must be a corresponding credit entry. So that means all assets have debit balances, all expenses have debit balances. So when you now say that all assets have credit balances, all expenses have credit balances, you have reversed the golden principle. So that will give rise to errors of principle. Okay? That's what we mean by that. Then we go to fraud. There are 5 types of fraud. Okay? Fraud can be classified into 5 categories. Number one, misappropriation of cash, misappropriation of goods, falsification or manipulation of accounts, window dressing, and last one, secret reserve. What is misappropriation of cash? Number one, what does that mean? That is money meant for a particular purpose, but the money was not utilized for that particular purpose. The money allocated for a particular purpose was not utilized for that particular purpose. A classical example is the Dasuki Gate that happened during the Jonathan era, when money were allocated to purchase arms and ammunition to curb the insurgency of Boko Haram. And this money was diverted amongst the cronies, among the ministers and government officials. So the soldiers were dying on the field, and the politicians, they are what? They are happy, they are enjoying. So the money for defense was embezzled. Okay, that is misappropriation of cash. Another example is the case of Dasuki Gate, Ikoyi Gate, where you had a house in Ikoyi, luxury towers, that is being accommodated by different foreign currencies. So you have dollars, pounds, yuan in that house as against human being living in that house. So remember that case that time. That's another case of what? Misappropriation of cash. But my money would have been that was meant for something else, but they diverted that money into that place. So many people lay claim to that money. The National Intelligence Agency lay claim to that money. River State government lay claim to that money, but we don't know the true owners of that money till date. That's another example of the reign of cash. Misappropriation of goods will arise where someone that is entrusted with goods decides to do what? Decides to misappropriate the goods. So for instance, the storekeeper that is in charge of the warehouse stole the goods without obtaining due approval. That's the misappropriation of what? Goods. Okay? The third one, falsification or manipulation of accounting records. So this is a fraud that promotes preparation of financial statement for different objectives. This is a fraud that is perpetrated to promote what? Preparation of financial statement for different objectives. Like you see, most organizations, they have 3 types of financial accounts or financial statements. There's one for the internal use, there's one for the external auditors, there's one for the tax auditors. The same financial statement. They have 3 versions, one for internal use, one for the external auditors, one for the tax auditors. You can see they have different objectives. So when that happens and it's seen as what? Fraud. It's called falsification or manipulation of what? Of accounts. Okay? The fourth one is called window dressing. Okay, window dressing is a way of presenting the financial data in a much better position than the original position. They try to make the financial statement to look so appealing for the investors. Okay, so when investors want to acquire a company, they will prepare financial statement to look so robust. Okay, so that to woo intending investors to buy into the company. So when that happens, it's called what? Window dressing. All right. Number 5, we have secret reserve. This is opposite of window dressing. This occurs when accounts are prepared in such a way that they disclose worse picture than actually what they are. The company is doing very well, but because they don't want to portray their their prosperity or they want to prosper their profitability, what will they do? They will report worst case scenario. For instance, they make huge profit. They will not say that they barely break even. Why? Because they don't want to pay higher taxes or they don't want to pay performance bonus to their staff. So they do that. They will hide the excess profit in one of those their reserve in the financial statements, okay? So that will not be conspicuously seen or detected by regulators or the staff themselves, okay? So that is what we call, those are the 5 types of what? Um, Fraud. Then we'll go to the next one, rational skepticism and fraud. What do you mean by rational skepticism? Remember, as an auditor, you're supposed to have an attitude of what? Rational skepticism. What does it mean? That is, as an auditor, you should have what? A probing mind. You must be able to examine all the information, all the evidence obtained. You're able to critique all the evidence obtained to be sure that you have the right information at your disposal. Okay? As an auditor, you need to do what? Have a probing mind against all the evidence obtained. Now to ascertain that the information at your disposal is accurate. That's rational skepticism. So, how does it relate to fraud? Now, any auditor that wants to go far in audit, external auditing, must have this attitude of operational skepticism. Okay, so that means the auditor should have that mindset that all things are and may not be right with the client. What would they do? The auditor should perform the audit with a suitable degree of what operational skepticism. Must not believe everything that is being said by the client. Be able to critique whatever information that is being presented. Number two, anything should discuss the possibility of fraud in the context of the specific characteristics of the audit engagement. What that means is that the auditor should always ask questions. The last audit that we did, between the last audit and now, has there been any fraud? The auditor should always ask that question. If the client is open, they will say yes or they will say no. But that is the pointer to show that there is fraud or there is no fraud. Number three, discussion should be held with management on the procedures or controls in place to detect or prevent fraud. So when they say there is no fraud, later we ask them, what are the controls that have been put in place to checkmate the prevention or detection of fraud? All right. The next one, the risks of possible fraud should be identified and if possible, and is if possible impact on the financial statement should be evaluated. So what that means is that if they say there is fraud, the auditor should need to evaluate what is the impact of that fraud on the financial statement. Because sometimes when there is a material misstatement on the financial statement, it will affect the profitability of the organization. Okay, that's what we mean. The next one, audit procedure should be designed to obtain evidence. Audit procedure should be designed, okay, to obtain evidence that fraud, which may impair the financial statement, has not occurred or has been detected and corrected. So what that means is that at any point in time, the auditor, if he has that attitude of operational skepticism, should have designed his audit procedure in such a way that he will be able to detect, okay, be able to detect and correct any fraudulent transaction, account balances in the client financial statements or financial information, okay? That the possibility of having fraud or perpetrating fraud will be what? Will be minimized within the organization. So that is what we mean by operational skepticism and fraud. So with this, I think we are done with the chapter. Is there any question, any comment, any observation? The only one that is not here that I need to also add to this now is what we call out of court settlement. Out of court settlement is part of this syllabus. Okay, I'm going to talk about it now. What do you mean by out of court settlement? I told us that in Nigeria, there has never been any case or cases where the auditors have been what? Liable. So what they normally do is what? They always settle out of court. So out of court occurs where the case has been what? Withdrawn from the court and is being settled between the what? Between the parties involved. a case that has already been presented before the court is being withdrawn and is being settled by the parties involved. So they took it out of court and they decided to settle it personally. That is out of court settlement. Okay, what are the advantages of out of court settlement? Number one advantage is this. It reduces legal costs. That is, the cost of hiring a lawyer, going to court, printing of materials, court documents, will have been what? Avoided. That's one of the advantages of out of court. Okay. Number two, the judgment, the out of court settlement may be cheaper than the judgment given at the end of the case. Out of court settlement might be what? Might be better or more considerate than the outcome of the court decision or court judgment. What does that mean? So if you have gone to the court now, by the time you compute the legal fees, document printing and everything, and the judgment that is served, and with the out of court settlement where, let's say for that one now that they've given a judgment, everything you had in your favor is 5 million naira at the end of the day. Okay? But out of court settlement, that one said that let us all go to court. I'm going to give you like what? 10 million naira. You can see that is cheap, is more beneficial to that party than 5 million naira. So that's one of the advantages of out of court settlement. That's why I said that the judgment, the out of court settlement might be more beneficial than the eventual judgment at the court. Okay. And you also need to know is that you talk about out of court settlement. What does that one also do? It protects the reputation of the audit firm. And that's why there's no audit firm in Nigeria that has been charged legally against what? Professional negligence. None in Nigeria. Because their reputation has been what? Has been protected. So these are the advantages. What are the disadvantages of out of court settlement? Number one, there will be no judicial precedent on any case. There will be no judicial precedence on any case. To look at the case I cited that relates to professional negligence, as far as 1932. So if they are settled out of court, we will not have any case to make reference to as regards professional negligence. That's what I mean by that. Okay, that's one of the disadvantages. There will be no judicial precedence. Okay. Another disadvantage of this is that because they settle out of court, it can lead to what? Increase in what? Increase in complaints by clients. So that means that the compensation will be what? Will be increased. So when you know that if you go to court, you are going to spend much time. But when you say that, okay, let's not go to court, let's settle amicably amongst ourselves. So that means that there's every possibility that the auditor will spend more, or the audit firm will spend more in settlement of their claim because more people will come forward, whether it's false claim or is their new cases, they will come forward and they want to get money out of the audit firm, and that will lead to increase. Okay. Number three, premium will rise. You know now, for you to be an audit firm or for you to operate an audit firm, you must obtain what we call professional indemnity insurance. It's just like a normal insurance policy. And the essence of that insurance policy is to guide against instances of this professional negligence. So if there are more cases of professional negligence, the insurance company will increase their what? Their premium. That means the audit firm will pay more. For instance, you have a car insurance, comprehensive car insurance, and for 4 years, your car has not suffered any damage. You keep paying the same insurance premium. But guess what? Once the car starts having damages or involved in accidents, the insurance premium will change. There will be increase in your what? Insurance premium. So it's still the same thing as we look at when it comes to the professional indemnity insurance. Okay? So with that, we are done with this chapter 4. Okay? So we've covered every aspect of this syllabus to the best of my knowledge and ability. Does anybody have any question, comment, observation?
Okay,
And I
Mr.
must
Desalu,
thank us.
thank you. There was an example you were giving about something that happened in Germany, and when you were talking about law of tort and civil liability, and you talked about privity of contract, right? So what
Yes,
is
sir.
not very, very, very clear to me now is
Mm,
where a company has contracted an auditor, then a third party that the auditor did not get into any contract with now says that they relied on the audit reports and they are now suing. It's not too clear whether the auditor is liable or not. But from your explanation, it seems as if the liability of the auditor, okay, is restricted to the company that contracted them, that now has rights
no,
to
no.
sue based on the contract that they entered into. So I'm just that gray area. Can you just clear it up for
Okay.
me, please? Thank you.
Thank you. All right. Like I said, there are different types of audit engagement. Okay. Now, if the auditor is carrying out audit engagement for a private company, for instance, the auditor is carrying out audit engagement of, let's say, A and B Limited, a private company. The auditor can say that that audit report is for solely the management of that company or management and shareholders of that company. You understand? However, where the auditor is has been engaged or appointed to audit a PLC, public limited company, like a bank, okay, the auditor owe not only the shareholders or the management of such organization, but every intended party to that particular engagement. That is, prospective investors are also part of that engagement. The auditor should bear in mind that he has uh, obligation to prospective parties or prospective investors. That's what I'm trying to say. So in the case of that Wirecard, is a PLC, okay? That is why somebody outside Germany or someone that is not a shareholder can prosecute or can institute an action against professional negligence on the part of the auditor, and it will become tenable. But if it were to be a private company, that is where we have that disclaimer clauses we apply, okay? But in Nigeria, as I speak to you now, we have yet to incorporate disclaimer clauses in our auditor's report. And the reason is not far-fetched. Nigerians, we are very proud, and I like that. And the reason is that you can see in most countries, once there is corruption, the aim of affairs of that organization of that country will quickly will resign. That does not happen in Nigeria. You understand? So the auditor believes that once they include a disclaimer clause in the auditor's report, it waters down the quality of the auditor's report. So that is one of the reasons why people have not been able to put that in Nigeria. Okay, but in advanced countries like in UK, they have it there. Okay. Now, to further buttress my point by Mr. Robin, I'm going to lay claim to, I don't want to talk about this because I said that you can read that on your own. I'm going to lay claim under the liability, auditor's liability that I talked about, the, what's it called? Criminal liability. I'm going there and I'll show us. You see what I'm saying now. Criminal liability, you see it there. Okay. Coming. I want to show us. You see it now. Just hold on. Okay. I'm coming. I hope I'll be able to see this. Look at this one here. Having stated the above qualification, it was pointed out here that the examination of auditor's liability cannot be done with mathematical exactitude. Okay? Mathematical what? Exactitude. Perhaps this person, this is the judge, was making the same point in the case of what? Adley Bain and Co. Limited and Ella and Partners Limited in 1964, where he said that I do not think it is possible to catalog the special features that must be found to exist before the duty of care will arise in a given case. So what happened in this case is this. Somebody that is not a shareholder in this company petitioned the court that the auditor, this is the auditor, Ella and Partners Limited, have been negligent in the performance of their audit work. And the auditor was saying that, no, we are only obligated to Ella, Pinley, and Co. Limited. So we don't have any obligation to anybody. And that is where the judge ruled that in favor of that person that instituted an action that I do not think it is possible to catalog the special features which must be found to exist before the duty of care will arise in a given case. So it depends on the nature of the case that we are talking about. If we are talking about a private company, then the auditor is only limited or is only obligated to the shareholders and the management. But where the organization is big, like a bank, a PLC, the liability is much more for the external auditor. I hope I'll be able to clarify that, Mr. Robin.
Yeah, that is fine. Thank you.
All right, so much. So, like I said, we are done with this, but I must say that I'm still open. Anybody that needs information about any chapter that you have talked about, from chapter 1 to chapter 16, I only say that you are free to reach out to me on WhatsApp. You can call me. Just tell me, just make reference to equity professional. I will be more than willing to render assistance to every one of us from now to the eve of your examination. All right. So the other material, I'm not sure you've seen it, and I've not seen anybody reminding me of that. I don't know why the thing did not deliver, but what I will do is that I'll try and compress the documents again, a video document, video recording of this thing. I'll try and compress it and resend again on or before Monday so that you can have it. Okay? If you
that's
don't
the
get
one on
it by,
evidence.
yes, one on evidence. That is audit or special aspect of financial statement. Yes. So someone should please remind me in case you don't see it by that time I said, because I want everybody to pass. I want you people to call me in next year or by December before Christmas that, oh, the result came out, I've passed. Let's go and jollificate. Let's go and marry so that we all enjoy our Christmas together. So I want to see us at the next level. I mean, at the other side. We are not going to any level again. We are going to the other side. We will not become professional colleagues. Okay? Please, feel free to chat me up in case you come. And now also, it's now time for you to practice more questions. Practice past questions more now. Our mock is coming up on the 2nd of November. How do we go about the mock? I'm going to set the question. I'm going to send it to this platform. And we expect that we make attempt of this question. Is going to be is more like a simulated exam question. Okay. So I expect that you all attempt it. Upon the response, when I see that there is a good response, right? I will now send the answers to us. So that in case any question or similar question comes out in the examination, it will be a walkover for all of us writing that this diet examination. All right. So thank you so much for your patience. Thank you for your understanding. Thank you for the love you have shown me since the commencement of this diet to now. I will never take this for granted. And I also believe that it's going to be the beginning of new relationship between us, okay? We'll still get to see physically one of these days. Okay, then we'll take the relationship further from there. Okay, I hope to see us in the future or when you're having your induction, that I'll be there to see faces, to put faces to the name I'm seeing on this platform. And I appreciate your support all this while. And if there's any way I've been able to have wronged us in any form or shape, please accept my apologies. And I believe that this exam, this diet, is going to be our diet. I'm going to come out successfully in this examination. So thank you all for all your support. If there are any question, comment, the class has hereby come to an end, but you can still reach me online, personally, between now and the eve of your exam. Thank you so much.
Thank you very much, sir. God bless you.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.